just in time for another episode of Business Redefined, your weekly most comprehensive look at the world of business and economics. We are now focusing on financing SMEs, and we're privileged to have Stephen Ngugi, the Chief Financial Officer at Family Bank. Welcome on set.
Thank you for having me today.
For a bank which prides itself in lending to a segment of this economy which is predominantly viewed, I should say, to be extremely risky, how do you navigate the risks which are created by SMEs?
So there are salient risks that comes along with lending to this sector. However, that's not to say that the sector is not bankable. In terms of risk management, so what we then do is that we try as much as possible to understand our customers, that's specifically the SME clients, and understanding the customers begins from which sectors are they operating in, are they in agribusiness, health, education, etc., and how exactly do they make their money. So we then work as much as we can to understand their business model, and it's only after understanding the business model that you can then be in a position to figure out then what are the risks that I'm likely to encounter within this. Obviously, from a bank perspective, we would quite be interested in cash flows. We do not necessarily need you to have audited financial statements, but there are quite a number of other ways through which we can then assess your levels of cash flow. We are happy to use your bank statements, whether from a savings and credit cooperative society or from another financial institutions. Besides that, we also do rely on your mobile banking records. So if you then have an Airtel money line or an M-Pesa line, we'll be happy to look at that. And in circumstances where the introductions are then done by US suppliers, we'll also happy then to rely on the records from your supplier in terms of how much have you then been purchasing from them on a weekly, monthly basis. And then through that, we are then able to make a lending decision.
And now that you are significantly skewed toward the micro, small, and medium-sized businesses, just curious to understand how your asset quality looks like, especially in light of the shakeout precipitated by the COVID-19 pandemic.
I think when COVID hit, what happened was that there were guidance which were then provided by Central Bank of Kenya to the financial institutions, predominantly bank, in terms of how well do we then accommodate our customers who are then going through difficult times. So part of those accommodations then involved giving moratoriums, both for principal and interest to our customers for a period of, let's say, 1 year, that is from 3 months to at most 1 year. And in some instances, and depending on the sectors which are greatly affected, you can then have the moratorium extend to a longer period. Then in terms of which sectors have then greatly been affected, I think within the initial weeks and months when COVID struck, we saw the education sector greatly affected when schools got closed, tourism and hotels. We also had transport and logistics. So much of the accommodation that we then did was specifically to those sectors. But again, we did the accommodation at specific client level. Then in terms of what you've then seen now, 12 months since COVID hit, we've seen quite a number of sectors bounce back. Education bounced back early this year. Tourism and hotels started bouncing back during the last year's festivity periods when even from the press you could hear that most hotels were 90 to 100% bookings. And when you then look at, say, trade, transport, and logistics, I think we're at a point where we can say they have really bounced back. Our assessment today would be 90–95% of those customers are now able to pay their expected monthly installments. And our experience from the accommodation we gave was that I think that accommodation was much needed, and had we not extended that support to those customers, then most of those customers would actually not be in business today.
When the central bank gave the guidelines around restructuring of loans, it was for a window period of 12 months, which has effectively lapsed in March, and we have spoken to the Kenya Bankers Association in terms of what's the way forward. And granted, there's no communication yet from the market regulator, but how do you see this unfolding in the months ahead?
I think the first thing is that COVID is still here with us. That's for a fact. The good thing is that there is now a vaccine. I think vaccination has also started in our country. And then three, we are almost at a point where, of course, albeit still complying with the health protocols, we are now in a position to continue doing business amidst COVID. Then four, if you then look at the provisioning levels that banks were doing last year, so in Q2 of last year, Q3, and again, we'll then be seeing the levels of provisionings that were done in Q4, you then realize that while there was the directive from central bank not to consider the moratoriums as a sign of a weakness in the client's ability to pay, banks started taking prudential decisions. So banks started taking in slightly higher provisions than they would ordinarily have taken. I think what that means is that from a banking sector, so the banks are quite in a very good position to remain stable and push through 2021 and beyond, even as we continue fighting COVID. And then two, from a business perspective, we've also seen sectors which we would almost refer to as COVID beneficiary sectors. And what has happened is that those sectors are now allowing banks to balance off the risk, which are, let's say, coming from significant risk COVID-affected sectors versus now the COVID beneficiary sectors.
And how do you see the pricing of risk in this market evolving in the months ahead? And why that is critical, as you and I do appreciate, is that ever since the rate cap was repealed, there hasn't been much guidance from the market regulator as to which models, the risk pricing models, should be considered. We understand banks have written to the regulator, they're awaiting feedback. But from your standpoint, how do you see this unfolding?
From a risk pricing perspective, so there has been progress. I think the first notable progress was the repeal of the interest capping law. And immediately thereafter, there was then a commitment from banks that banks will then continue being responsible lenders. And out of that, there was an agreement that banks will then have to submit their pricing models to the Central Bank of Kenya for review, then just to make sure that, yes, banks are complying with the charter to which everyone subscribed to. While pricing models are still under review, my perspective is that it's highly unlikely that we are going to see interest rates at levels we had before interest capping law came. And the reason for that is because I think today banks are well positioned, especially from a cost structure, to work within reasonable or constrained net interest margins. Then two, I think there is more transparency in pricing. So today customers can figure out who is charging X and then say who is charging X plus one. So for as long as there's then that transparency, it's then highly unlikely that pricing will be to the same levels that we had before capping. And then three, if you look at, say, for instance, the levels of non-performing loans, especially before COVID struck, and do a comparison between NPLs before interest rate capping and NPLs after interest rate capping, what you realize is that there are no real significant differences. And what that means is that a higher price may not necessarily be correlated with the quality of that front portfolio in years to come. So the quality is more so dependent on how the entrepreneur continues running the business and whether that business will still be surviving in 2 to 3 years' time. So my perspective is, yes, we're likely to see a slight increase in some credit rated, that is lower credit rated customers, but it's highly unlikely that we'll get back to, say, higher than 20% levels that we had before COVID struck, or before interest rate capping.
You've spoken about banks are well positioned from a cost standpoint, and that speaks to the efficiency when you look at the cost to income ratio. But then my question is, how are they positioned from a liquidity standpoint? Because then that plays very significantly in terms of the stability of the entities.
From a liquidity perspective, so you can look at it from quite a number of ways. So the first measure of liquidity will, let's say, be what's the minimum liquidity requirement as per Central Bank of Kenya regulations. So today, that still stands at 20%. And then besides the liquidity ratio, then there's also the cash reserve ratio, that is the proportion of your deposits that you then need to keep with Central Bank of Kenya, which during COVID times, that was slightly lowered from 5.25% to 4.25%. Of course, what that means is that there was more liquidity released into the market. Then, in terms of where do we see the bank's liquidity position sitting in at this moment, I think there is slightly higher liquidity, and maybe for two reasons. So one, when COVID struck, a number of businesses postponed their investment decisions. What that means is that there was less demand for borrowing, and the alternative from a banking perspective would then be, if you have liquidity which customers for any reason are not coming for, you then have to invest that in, for instance, government securities, which within this period are also giving quite reasonable returns. So, and I think then that one speaks to the levels of liquidity we currently seeing in the market. The other source of the liquidity has been, if you look at especially the tier 1 banks and tier 2 banks, there has also been quite an active participation from the development financial institutions. So if you look in the press over the last couple of weeks, you've seen quite a number of banks sign long-term funding with DFIs. And that's also a source of liquidity for the financial institutions. My perspective would be that in 2021, we'll then start seeing lots of that liquidity moving from government securities into private sector lending. And that's part of the bank's responsibility in terms of supporting businesses which were vastly affected by the COVID pandemic to then start going back to their businesses.
All right. And that point by Stephen Ngugi takes us to a short break. Business Redefined will be back with a lot more on this conversation, focusing on lending to SMEs. Stay tuned. Welcome back to Business Redefined, your weekly most comprehensive look at the world of business and economics. We are discussing lending to SMEs, and we are privileged to have Stephen Ngugi, the CFO at Family Bank. Welcome back on set.
Thank you.
A while back, there was a bit of a challenge in the interbank market, and the liquidity conditions were a bit tight, whereby the tier 1 banks were not easily lending to the mid and low tier banks. I'm just curious to understand, now that you play in this space, how has that evolved over time?
Yes, so thank you very much, and understandably so. So because I think there are challenges in the market. That's 3 to 4 years ago, and what that meant was that banks all of a sudden then could not trust each other, and especially when you then look at, say, tier 2, tier 3, and tier 4, the banks within those tiers suffered in two ways. So one, we saw customers move their deposits from those banks to tier 1 banks, so that was pretty much flight to safety. And then two, we also saw the interbank markets, especially the trading between tier one banks and the rest of the banks, take a hit in terms of close to a complete slowdown. However, over the last 3 years, and in this case we'll then be speaking to 2017, 18, 19, and even last year in 2020, the market that is within the financial services industry has been quite stable. We've not had any instabilities from any financial institution. And what that has done is that it has then built that confidence back. And today, we do see those relationships back on track. So we do have tier one banks which are lending to tier two, tier one banks which are trading with tier three banks, and even vice versa, because at times you'd have a tier two or a tier three bank which is then holding higher than necessary liquidity, which they'll then need to deploy to the tier one bank. So there is more market confidence, there is more trust within the financial sector players, and we do hope and pray that that remains the case and the market gets even much deeper.
Walk us through your revenue diversification strategy, especially in light of the challenges we are having in lending to the private sector because of the risks that exist out there. How are you looking then from the non-funded side?
As part of generally financial institutions then remaining stable, of course at the back of the interest rate capping which did the bank 4 or 5 years ago, what has happened across the industry is that while 5 years ago you'll then find financial institutions or banks with 80% funded income, which is primary interest income, against, let's say, 20% and unfunded income, we've seen that change over time. And specifically within Family Bank, what we've done over the last couple of years is then to keep asking ourselves, how can we then reduce our dependency on the funded income or the interest income side? And what that meant was that we then needed to start focusing on other revenue sources. And what comes to mind would be one, trade finance. So we're quite entrenched and big today in trade finance. And you're then looking at the whole retinue of products. So from performance bond to advanced payment guarantees, LPO financing, invoice discounting. So we've seen that grow fivefold over the last couple of years. Then two, we also have treasury. So treasury is also a significant source of income from a non-funded income side. So again, we've also seen significant growth within that line. Then we've also been looking at how do we then continue, for instance, giving value to our customers even as we then make a shilling out of it. And what that has meant is that we've had to look at our distribution. So today we're quite active and we are quite present in both mobile banking, internet banking, and agency banking. And what that means is that we are in a position to reach more customers than we would ordinarily have had we only relied on our 90+ branches. So that means that from a customer engagement perspective, we are more relevant to our customers. And as a result, we've also seen our transaction income grow.
We have seen Family Bank open branches in the recent past at a time when majority of banks are clearly scaling down on the brick and mortar, and it's for obvious reasons. We are trying to enhance cost efficiency and therefore trimming back on that. Majority of banks will tell you now 90% of our transactions are actually on the digital platforms. Do you feel you are going counter-current, or how is the strategy like?
We still continue distributing pretty much a significant portion of our products through the branches. Of course, then that not to say that we are not making use of the digital channels, whether ATMs, mobile banking, or internet banking. But our view of banking into the future is different in terms of, if you then were to look at traditional branches, so they were pretty much service centers. So there were places where you then go for cash deposits or cash withdrawals or to make a loan application. So we've successfully moved cash withdrawals and, let's say, cash deposits either to the channels or to our agents. But we are on a journey towards converting those branches from service centers to sales centers. So our long-term view of our branches would be a place where customers would then come in more for advisory services than to get the service itself, because they can self-service themselves through the channels. And since we would still want to reach a higher proportion of the country or of the population, we still do believe that having branch networks then gets you closer to customers, and it also then allows you to, on a continuous basis, make your presence felt by the customers.
Getting back to the revenue diversification, you did mention treasuries, and I would just like to understand. At the end of Q3 and Q4 last year, we saw quite a bit of volatility on the shilling. And just curious to understand how this impacted your performance, because clearly there was a bit of a slide. We've seen it stabilizing this year, but just to understand how this impacted your side of the business.
I think to answer that question, then I think we then need to ask ourselves then, why was the shilling volatile at that point in time? Was it volatile out of proprietary trading by treasurers, or was it volatile out of a supply and demand imbalance? And our perspective is that the volatility last year was primarily driven by the supply and demand imbalances than, let's say, absolute opportunities to make arbitrage or to make money out of that volatility. So because what we saw was COVID struck from an export perspective, whether you're talking about flowers or tea or any other horticultural product, then the markets had crossed. So what that means is that we had less dollar inflows into the country. Then two, if you were to look at, say, the performance at the Nairobi Securities Exchange, it also got affected. So we saw outflows where a significant number of foreign investors were then taking flight. So reason being, there were models which had then predicted that COVID would, for instance, hit Africa and East Africa and Kenya in particular at large scale than what we let alone saw. So therefore, in terms of was volatility an opportunity for banks to make a killing or to make a lot of money? I think the answer to that is no. So on the basis that you don't really make money when demand and supply is quite active and working. But what we then saw was then banks coming up and assisting customers to manage their foreign currency risk. So we saw quite a number of customers come to the bank for forwards or for swaps, but purely to manage their FX risk, but not really to take advantage of the volatility.
That's quite an optimistic note, I must say, Stephen Ngugi. Much appreciated for your time. That takes us to the close of our conversation on Business Redefined, where we have been looking at lending to SMEs and how essentially it really risks these enterprises to have more credit flowing to that segment of the economy. Up next is the Markets Report.